Welcome back to the Williams Real Estate channel. Today we are discussing a new offer I'm providing to all repeat clients is a portfolio plan. As you continue to build out your portfolio, you may wish to understand where each of your properties are heading based off the 18-year land cycle framework and the long-term historical trends. This will be able to give you clarity to know where each of your properties sit within their own sub-market to then work out whether you renovate the property, develop the property, look to sell the property, buy more in that same area. It gives you clarity of what to do. As you keep building out a portfolio, we've got the phase one where we go 10 in 10 years, a couple of individual units, a couple of houses, a duplex block of units. Once you're at that point, it's like playing a game of chess. And at some point, you will need to reshuffle, consolidate a little bit to offload one or two, pay down debt, raise cash to then reinvest into bigger deals as you keep growing your portfolio. If you wish to go from 10 to 20 properties, 20 to 30, and so on, you'll find the big investors who have hundreds, if not thousands of properties, never end up holding everything that they ever bought. So I am looking to move and shake. Personally, we'll run through my own portfolio plan. We'll discuss it today of what I'm thinking of doing. It's always a moving target based off how much money, income, capital you've got, how much serviceability you've got, the market cycle of where each market is heading. So it's always a plan that's ever evolving. And I look at my plan every month. I'm always strategizing on what I should do, what I should buy, what should I sell, what should I renovate, what should I develop as I continue to build out my portfolio. So we use the 18-year land cycle. This is our framework, consists of 14 years of expansion, 4 years of downturn, and the mid-cycle slowdown interrupts the 14 years of expansion. We're on this blue marker, equivalent point of time around late 2006, coming into now 2007, equivalent point of time in the prior cycle. So we'll run through these long-term trends. And if you look at what happened from 2006, 7 and onwards, that's a guide of where each market could be heading into the future as we come into 2026 and beyond. So we'll run through this. This is my personal portfolio, and this is what I look at when I'm looking to think about, okay, do I sell, as an example, a house now in Tamworth? I've never sold anything, and I've got that wog in me that is an emotional tie, I guess you could call it, that doesn't want to sell. You know, buy real estate, never sell. That's almost ingrained into myself as well. And I've been telling myself that shit, I need to sell this stuff because, as you can see, Tamworth has been away at the races, charging. But if we look back at history from 2005, 6, 7, it topped out and pretty well went up and down stagnant for a good 7, 8, 9 years before picking up and running through its next growth cycle again. So I've got a house out at Tamworth. I bought it for 120 grand. Now I could probably sell it for 400 at least. It's in a rough part of Tamworth as well, so it's not in the most desirable area. It's in the more heavy, thick housing commission pocket. So coming into a market top come 26, it's definitely on my radar to put on the market to sell, as it's one of those assets that has done me very well. Obviously, over the last 4 or 5 years, I bought it around 2019, 2020, and it's tripled in value. I could easily sell that now for say 400, raise say 250 grand cash. That could be a deposit to buy a block of 3 or 4 units, a whole unit block in the likes of Victoria that's set to go through its next growth cycle over the next 5 to 6, 7, 10 years. Meanwhile, Tamworth will do next to no growth. So that's what I'm strategizing around. Why hold a house through a period where it'll range from 350 to 400 for a good, call it even 10 years before going from 400 to 800 when I can sell that, pay off the debt, raise cash, strengthen my balance sheet as we go through the land-driven downturn, and then also buy a deal in the future years ahead to capitalize on the future growth cycle. So that's how I look to move and shake. Obviously, I haven't sold anything to date, but this is how I'm working out what to offload, what to sell in order to scale up. Because in my mind, I'm trying to hit 100 rentals, and that's going to consist of all blocks, unit blocks. And in order to get there, I have to let stuff go, which all the individual properties eventually will all go, even though some of them I do like and I'd like to hold on to them. I'm thinking at some point everything is just going to have to be sold. So that's how I see Tamworth playing out. And my strategy moving forward is Muswellbrook. So as you can see, Muswellbrook has had a solid run in the recent years. And if we look back at history from 2006-07, continued to steadily rise, but then more or less topped out and went pretty well stagnant, flat, and then softened after the mining downturn and then picked up away. So Muswellbrook definitely has a long stagnant time horizon ahead of it. So definitely not a market we're buying in at this stage. I bought 2 units. So it's a block, it's a duplex, 2-unit site, small block of 2. I have since lodged a development application into the council to build a 3rd unit out the back. This is one that I'm thinking of just keeping anyway long term because it's got good cash flow because it's a multi-resident site. So even though, yes, it's due to go through this more stagnant, subdued period, but it's one of the ones that I'm looking to keep. Raceview is a house. This is out Ipswich Way in Brisbane. I've got a house out there, 3-bedroom house. The market has been turbocharging in recent years. I purchased it around 21 for 250 grand. Now everything's hitting close to 800,000, so it's done very well. And if we look back at history from 2005, 6, it continued to go strong and then topped out. Didn't go through as severe downturn, but leveled out, still had steady, modest growth. So potentially one I may look to keep long term because I could duplex this site. It's on a big block of 600, 650 squares. It's got a house situated to the front of the block, brick home, slab on ground. It's one of those old school type style built in the 2000s. I could quite easily duplex convert it by way of putting a firewall through the middle of it, extending out the back, and color bond through the backyard fence to convert it into a dual occupancy. So that's an option I'm looking at and potentially will do and keep it for the long term, as this one is more of a resilient blue chip type of area that will continue to kick on and go strong. Woodridge, I've got one single story villa and one townhouse, two bedrooms, separate properties. So I've got 2 properties in the same suburb. They've done very well for myself over the last couple of years. We bought the first one in 2018, the second one around 2020. First was 160 grand, 165 grand. The second was 152,000. These days, there's nothing really selling sub 450 and everything's flying out the door at close to 500. We'll continue to go strong as we see back in history from 2006-07 and then topped out in 2007-08 and then went through a good 11, 12 years of stagnant flat growth. These ones are definitely getting sold. They have done well. They've tripled in value, and I could easily raise 250, 300 grand cash from selling each. So a good five, 600 grand, which could easily use that as a deposit to then roll into small blocks of apartments. So these ones will go as they don't have any development upside. I need to renovate one kitchen and a bathroom in each one. One needs a new kitchen, one needs a new bathroom. So I'm planning to sell these probably early to mid next year. So vacate tenant, renovate, run them to auction with no reserve. And I'm planning to stand there on the day. And if need be, I highly doubt it, but if need be, I can always throw in a vendor bid for 500 grand or so. But I will be happy to sell them at fair market value because we'll be selling out at peak market. So that's a good way I'm looking to sell is to draw the community in by having no reserve. And the more people there on the day will create more competition, which ultimately drives top dollar. I'll look to set up a little coffee cart or Bunnings barbecue, make a bit of a hoo-ha. It'll be a funny old day and auction them off like hotcakes, peak market. And we will come back to Brisbane at some stage and do the same, but I don't see the purpose of really holding these types of little properties anymore because they've done their course. They've supported me get into multiple other properties. They're like kindling to the fire, and at this stage, they're not really making much of a difference to my portfolio anymore. So I could sell them off, pay off the debt, raise cash, and then roll it into larger deals as we continue to build out the portfolio. Lithgow, yeah, this one should have already been sold. It was my second property I ever purchased. It's a house, two-bedroom, little gun barrel house out at Lithgow. Classic little home, freestanding house. I really love the house. This is emotional now. I should have already sold it or should sell it now. But it's one of those ones that I might just keep just for the sake of it. I bought it for 220, 30 grand. I could sell it for probably 500 now. It rents for 450 a week, so solid yield and double brick gun barrel, very low maintenance, dual access. It's a cool little house. So I'm thinking at this stage, I'll just maybe just keep it, even though it's probably not the most wise decision to keep it. As you can see, from 2005, 6 and onwards for a good 10 years, it's probably not going to go anywhere. So at this stage, I'm not in a rush to sell it. I might sell it. It's much like my boat at the moment. The boat's on the market for sale. If anyone wants it, I'm definitely not motivated to sell it. So it's one of the ones that this is when the emotions get involved. It should be sold, but it's such a beautiful house, and I can see Lithgow coming a long way. It's already come a long way. It's gentrified. I remember buying it in 20, 18, 17, 18 around here, and people thought I was crazy. Why buy in crack town? Everywhere improves over time. It's part of the strategy. Without getting into areas that may have the reputation today, but ultimately will flourish in time, and Lithgow is one of them. Lithgow, at some point, will get a new infrastructure. Their plans are to build a tunnel through the mountain range and come out just before Lithgow. So that will also explode the area. And I can see a town like Lithgow being like the next Balmain, where it's gentrifying, it's becoming more desirable, it's becoming more bougie, and it's very landlocked. So you can't build out further because the mountain ranges are all national park. So it's very fixed in supply in the desirable pocket. So I see Lithgow doing well, even though at this stage it's due to go through a pretty well subdued, stagnant period. So time will tell, see what happens, but at this stage I'm just letting it rent out. Next is Grafton. I've got a house in Grafton. Again, another one that's showing signs of coming to a top, just like what happened in 2006-7. Has got a little more way to go, a couple of years to keep rising. But again, a property that I will look to sell in the coming years. This particular house is on the rougher part of Grafton in the closer housing commission estate. So is one of the ones that's probably not as a desirable one to keep long term. Has done very well. I bought it for 187,000, and these days this could be sold for 400 mark. I'd say there's not much selling for sub 400. So that one in a couple of years will probably get sold to reinvest into larger deals. Warwick has been away at the races. Warwick's about an hour south of Toowoomba, has done very well. Will continue to go strong for another couple of years, but then eventually will level out, top out around 28.9, 30, and then go through a more stagnant, subdued market. So I've got a couple of years to decide on what I want to do with it. It is a 3-bed brick home on a large 700 or 800 square meter block. I could put a granny flat in the back. I could even duplex convert it. I could even knock it down, put 3 or 4 units or villas or townhouses on it. So it's got development upside. It's got options. We will decide on what we would like to do. At this stage, I haven't started a conversation with council, but there's options there. Whether or not I'll sell or keep long term, going by this chart, I'll probably sell it because I'd rather not hold an asset through a subdued, stagnant period like this. I bought it in 2020 for 170,000, and now I could easily sell it for 500, I'd say. Dalby, I love Dalby. Dalby's a great town, about an hour northwest of Toowoomba. I've bought 3 houses out here. Interesting town, Dalby. Hypothetically, I could develop all of them. I could put 3 or 4 townhouses on all of them. But Dalby floods. The water comes up very slowly and then it goes down. The whole of Dalby is elevated. All the houses are high set, between 2 meters off the ground to a half a meter. So it's not an issue for the town. They've structured it and built it well over the years to manage the flood level. It's just very flat. It's like a floodplain. And the town lacks adequate infrastructure, including stormwater drainage. So after a big rain event, the water pools in the streets and doesn't drain away because it doesn't have the curb and gutter and stormwater. It's got like the old country road bitumen onto dirt. So it comes up on probably 80% of Dalby comes up as being in a flood zone, even though it's not technically flood. If they had adequate drainage, you'll drain away. So I have had conversations with council to develop them all, even though there has been precedents been set. And at this stage, they're saying no, which is absolutely crazy because if you look at how many rentals there are in Dalby, there's only 2 or 3 ever at one time. So they're desperate for the stock, for the rental stock. And I would be building it today because the price points now, 450 mark. I started buying in Dalby for 120 grand, stopped around 222,000. So they've all doubled, if not tripled, in value. Big blocks with development upside, but at this stage, the council's saying no. But at some stage, once they do put the drainage in, they'll loosen that environmental, or they'll loosen the restrictions, and they will probably be allowed to be developed in time. Whether or not I'm going to wait around that long, probably not. Because as you can see, It's been booming recent years, will continue to go strong over the next 2 or 3 years. But just like what happened from 2008, 9 and onwards, the town switched off and went backwards 30, 40% over 10 years. So I'm definitely not holding the houses through then. That period of time, come 28, 29, I'm going to have them all sold, peak market, and in the interim, if I can manage to get the council to allow me to subdivide them to build second dwellings, I will. So then I have 6 properties to sell come peak market, but likelihood unlikely at this stage. Can't see it unless the council changes their mind and allows for more dwellings to be built in low-lying floodplain areas. Even there's precedents been set. 10, 20 years ago, people were putting 3 or 4 townhouses on sites, and they've only recently, in the last 5 years, increased the restrictions on future development because of the recent floods out there, and it's restricting supply and it's sending rentals to the roof. The rents are $500 to $600 a week per house. It's absolutely insane. So the local town is definitely feeling the pinch. They need the stock, and the councils are only holding that stock back. So Darwin's an interesting one, but the volatility is definitely a reason not to hold long term, because during this period from 2009 to 19 will be like 2029, 30 to 2039, 40. I would rather sell out, pay down the debt, raise cash, strengthen balance sheet, strengthen financial position, preserve capital, reinvest that capital into another market in bigger assets that will double, if not triple, in the same period, than holding an asset through that period. So if you've got houses in regional Queensland, definitely worth running the reports, because Dalby is probably one of the more resilient ones. The likes of Cairns, Rockhampton, Townsville, boom bust even harder. So you all have a beautiful opportunity now in the next couple of years, and you won't have that same opportunity in 5 to 10 years' time. So definitely worth getting these reports and running them and seeing where your properties sit before it's all too late. Regional Victoria, now I'll keep you guessing for now. We're buying predominantly across Victoria and in Sydney at this stage of the cycle for the future growth cycle. So if you want particular suburbs, get in touch, jump on a call, sign up. We can help you build out your portfolio. But we are in regional Victoria. I bought a block of units, block of 4. Even though this chart doesn't look the best in terms of long-term trends, it has had recent strong uplift and is a bit more due to go through a bit of a softer market before then picking up again. The deal was right. Provided the deal is right, this can be used as a guide to understand where the market's heading. But if you come across a deal and the deal makes sense, then it doesn't necessarily mean you have to be exactly tied to what these long-term charts say. Because I bought a block of 4 one-bedroom apartments for 665 grand. Today it's worth about $1 million. Return 70,000 a year. That's over 10, 11% return. 4 one-bedrooms, brick, ColourBond roof. I've got depreciation reports done for the recent renovations. It is a long-term hold type of property. So we use the long-term trends as a guide, but if we're looking to buy, say, blocks of apartments in the regions, we're not always tied to it if it's a long-term hold cash flow play. These reports are definitely used if it's a short-term, being 3 to 7 year play, where we buy a property, we hold it through the market cycle, it doubles, if not triples in value. We then look to offload, to raise cash, pay down debt, reinvest it into blocks of apartments. Just like playing Monopoly, buy 3 or 4 greenhouses, roll it into a hotel. Maitland, this was the first property I ever bought. It was a 4-bedroom house. Still got it to this day. Interesting story with it, actually. I purchased it, renovated it myself with my wife, kitchen, bathroom, paint, flooring. In hindsight, I would have got a contractor to do it because it took me 12 months to do and just as much as what they originally quoted me to do it. But it was a good learning curve. It was the first property I ever bought, and the plan was originally to sell it, to flip it, to do a couple of flips, to roll into a house in Sydney because I was priced out of Sydney. But then I stumbled across the book that Robert Kiyosaki famously wrote, Rich Dad Poor Dad, in Maitland actually, during the time I was renovating it, coming towards the end, and it had the penny drop moment that you actually make money in holding property long term for cash flow appreciation and refinancing rather than buying, renovating, and flipping, where you don't actually build much wealth. You make it ideally a profit. Sometimes you don't, because when I went to sell, it was during the credit crunch from APRA in 2018, and I couldn't sell it to make a decent profit. I was pretty much going to give it away. So I thought, keep it. I've spent over a year buying and renovating it, and I still have it till this day, and I probably won't ever sell because it's in a pretty solid market. As you can see, it has kept on going strong from when I first bought it in 2017. I bought it for 240,000. Today, it's probably worth about 650 mark, and it will continue to tick along and go strong. So it's a good asset in the portfolio. And I see the likes of Maitland being, again, the likes of Balmain, Rozelle, Paddington in time as it will continue to gentrify. And I really like Maitland region too, being the reason is it's quite landlocked. So you may look and see, shit, there's land as far as the eye can see, but a lot of it is landlocked because it is floodplain. So there's only certain pockets along the ridge that you can develop and can build housing. So even though there is a lot of farmland in the Hunter, you can't build on it all. So, which is good, restricts supply, continues to keep pent up demand, people coming out of the Central Coast and out of Sydney as they get priced out, they go up into the Hunter. I love the Hunter, and the Hunter will continue to keep going strong, as you can see on this long-term chart. So it's probably one I will never sell, unless if I'm going to sell it and roll it into a block of units. But within the next 5-ish, 10 years, probably not. But time will tell. And Melbourne, we're buying Melbourne. As you can see, Melbourne it's already started, depending on what chart and what suburb you look at. It's already started. The deals were easy to come by in 24 than it was in late 25. So I feel since middle of 24, it troughed out and has been steadily rising since June 2024 to date. And it's only been accelerating in the last couple of months. And come 26, 7, and 8 and onwards, it's only going to continue to accelerate, especially once the likes of Queensland, WA, Northern Territory, Adelaide clearly show signs to the mainstream that it's no longer a good idea to keep buying in those markets once they enter their downturn in the next 1 to 3 years, depending on which market you look at. Once they do show signs of clearly evident downturn, that's when the demand will shift back to Sydney, Melbourne, and Sydney, Melbourne will be away at the races again, just like what happened from 2008 and onwards. So when people say, why are we buying now? If a downturn's coming, there's not one property market. There's always a market prime for growth. And this is my portfolio to date. I need to sell Tamworth, probably will. It's coming to peak. Lithgow, I probably should have sold that already, and even Grafton. There are definitely 3 properties that are on the chopping block, but definitely Woodridge and Dalby and even Warwick as we come into the next 3 years of market top. They will go because the downside risk in regional Queensland is real, and I would rather avoid that and reallocate funds to put into the likes of Sydney, Melbourne, regional Victoria, regional New South Wales for the next growth cycles and preserve capital moving forward. So that's a snapshot of my personal portfolio, my thoughts, my processes of what I'm thinking of doing, which I'm always rehashing based off my income, my borrowing power, my equity, and the market of where each property sits. So some people come to me and say, what should I sell? Personally, I can't give financial advice. You got to make your own decision on what you wish to sell. What I can do is I can run all your reports on your properties, create a slideshow just like this, and show you where each of your properties sit based off the 18-year land cycle framework, based off long-term trends, and then you can make the decision on whether or not you wish to sell or hold it for the long term. This is for me. This is my story. This is by no means financial advice, but this is what I'm thinking is when I will probably sell is when I get to a stage when I can't borrow anymore because if I'm capped out of my serviceability and if I can't borrow, and the only way to create more borrowing capacity is to free up my serviceability by paying down debt. In order to do that, I'll need to sell, reconsolidate, sell something to raise cash, pay down debt, free up serviceability. I then look at my portfolio and then think just like what we've run through today and look at the long-term charts and say, okay, well, if I need to sell, what do I sell? It's something that has a high probability of not going through a significant growth cycle within the next 5, 10 years. If you look back at history, you'll find that every market around Australia, on average, goes through a 10-year stagnant, subdued growth path, and then also goes through a 5 to 7 year bull run where it goes up 150 to 200%. If you can get a good deal on the way in and sell out at the peak, you can triple your money. But the medium price point goes up between 100 to 150, 200%, then tops out, softens, and then goes through another 10 years of stagnant growth. So depending on which market, some markets go through longer stagnant periods and downturns, some go through less. But on average, 10 years of stagnant, 5 to 7 years of bull run. So if you wish to continue to build out your portfolio and get from 10 to 20 to 30, at some point you may need to let things go, unless if you have ever growing income coming from, say, like a business. So if you have that luxury where you've got the income and you don't need to free up serviceability because you've always got it, then keep it and just refinance it and roll it into the next deal. As always, that is by no means financial advice. As I'm not a financial advisor, please make sure that you talk to your financial planner, financial advisor, tax accountant, do whatever you got to do. But if you want help buying an investment property and building a long-term sustainable portfolio, and if you wish to be a repeat client, I'll be sure to provide you a slide pack just like that for your personal portfolio so you have clarity of where we sit in the market and where we're going into the future based off the 18-year land cycle and how your properties will perform in the long term. Thanks for watching. See you on the next one.